Great. So welcome to question solving stage of IAS 37. It talks about provisions, contingent assets, and what? Contingent liabilities. That is all. If you look at the tutorial section, we are now going to look at that of the questions. So we are going through a series of questions on provisions and how we should handle them. How we should handle provision. So let's see where we'll pick our first questions from. Great. First question. Great. Now let's look at this question to just warm up. We are looking at the E. We are just looking at the E. Here. The definition of a liability forms an important element of IAS framework for presentation and for preparation and presentation of financial statements, which in turn forms the basis of IAS 37 provision, contingent liabilities, and contingent assets. Required. Distinguish between a liability and a provision. Distinguish between a liability and provision. And describe the circumstances under which provision should be recognized. I like this question. So first, let's go to the board. What is the difference between a provision and a liability? The examiner wants you to understand these terms into detail. Are they the same thing? No, they are not the same. Like, no. Even though one is an example of one, all provisions are examples of liabilities, but not all liabilities are examples of what? Provision. So let me put liability here. The mother and then the small pikin is the provision. Okay. Now we define liability as the present obligation. Present obligation arising from past events from which future economic benefits are expected to flow out of the entity, meaning that a liability will result an outflow, that is a settlement paying. Okay, so kindly use that one. So first difference, the marks is here, they're just looking for 1 or 2 points because 5 marks, the next one will take 3, this one will take 2. So point 1, use the definition. Define all of them correctly to set out the difference. Present obligation arising from past events, and then you continue, right? You know that definition is so common. Present obligation arising from past events from which future economic benefit is expected to flow out of the entity. That is all. What are provisions? Provisions are liability with uncertain timing and amount. Uncertain timing and amount. That is all. Uncertain timing and amount. That's a fair difference that I'll talk about. Fair difference that I'll talk about. Second, let's look at the second difference between provisions and then liability. Good. You know, liability, that one is certain. Yes. For a liability, it is certain. But for a provision, no, you don't know when. Provision simply means you are owing, but you don't know the exact amount to be paying and the actual amount. But circumstances today has imposed certain liability on you that you don't need to pay them today. You pay them in future. Provisions are to be settled in future dates. How do you get it? Provisions are to be settled in future dates. Liabilities. That one now. Good. So take notes of that, and you will be fine. Okay, so basically that is that. So let's move on with that of the game. Without of the game. Now look at how we are going to answer the next question. So in short, just define liability, define provision. You are done. Good. Then you can move ahead. 1 mark, making 2. Yes, that is the skill. And then describe the circumstances under which provision should be recognized. Okay. What are the recognition criteria for provision? Watch carefully. Tell the examiner that provision should be recognized if and only if the following conditions are in place. So provisions should be recognized if. So the circumstances, the conditions, what are they? So tell the examiner recognition criteria for what? Provision or provision. It must be recognized if the following conditions are there. Condition number 1. Condition number 1, there must be a present obligation. Present what? Obligation. Go further. Tell the examiner that present obligation exists when or exists by when there's a what? Exists by A, legal, B, contractual, so through contract, right? C, by what? Constructive. Constructive. The conditions are 3 in number. This one is the first condition. So if you state this, if you state only this, you not mention anything. This one, they are just giving, explaining present obligation. There is a present obligation if, first, there's a legal requirement, the law imposes some liability on you. 2, there's what? Contractual. You've entered into a contract with someone, and now it has imposed certain liability on you. Constructive, your past actions. Every day, you have been doing good to someone when some terrible things happen to the person. One day, they say terrible event, it's okay. And now they are calling you for help. Don't say that, oh, you've not signed, you've not entered into any agreement to be helping them. No, your past action imposed a liability on you. Implied. there's an implied version of it. That is all. Then we go to point number 2. Even if any of these three is there, there's a present obligation. Point number 2, then tell the examiner if it is probable. I have to know what to continue, right? As soon as you hear the word probable, then you can continue, right? It's probable that future economic benefit will flow out of the entity. That's how I'm going to go. Number 3, don't tell the examiner the cost. No. Don't tell the examiner the amount. No. Don't tell amount, don't say cost. Cost goes to PPE or assets, tangible one. Amount goes to a liability. So take note if you are stating the point. Cost goes to PPE or inventory. Amount goes to liability. What about provision? Provision have its own, tell the examiner, estimate. All provisions are estimate. All provisions are estimate. But you can even add it to the distinguished features. Under the provision, put estimates there. And the liability, put actual. Liabilities are actual. Liabilities are not estimate. How we get it? Good. Anytime you are estimating a liability, that means you're making a provision. Take notes in the book. Number 1. So here, a reliable estimate can be made. That is all. So say a reliable estimate move with provision. So take notes of this. We are done with this particular question. Let's continue with the game. The game is getting interesting. Let's continue. I think I have another one here. I think that one we will probably look at it again in different schedule. I will look at it in a different schedule. Let's go to our next question. Okay, so let's see this particular question. And I like the question so much. Interesting. Interesting question. I like that question so much. Fantastic and fantastic. I like that question. Okay, so this one is not directly. Now, almost all the provisions, you will see them again in another standard, so they can ask you those questions together. For instance, provision for dismantle is also under IAS 16. The same thing under IAS 37. So take note of that. So this is how this question looks like. So let's look at this particular question in here. Now, like this, we've solved this question before under the IAS 10. If you look at later videos in there, but this is a perfect place. Let's check just the II. It is about event after reporting period. The company financial statement, they reported in December. They prepared the account in December 2015. So this year, December, sorry, I think that one was a different question. D, so unlimited telecommunication company, which prepared financial statements for the year ended 31st October 2015. So if it's end October, from the third month going, so October, November, December, January. So from January going, they can publish their account. Good. The financial statements are due to be authorized for issue in 15th of January 2016. Now what happened is this. In December 2015, the directors of Swan Limited publicly announced a plan to reduce the workforce by 10% as a result of worsening economic conditions. This event was reported to at the same time under IAS 37. We call it restructure or restructuring. Now, restructuring comes with own provision. Tell the examiner that they need to make provision if and only if the following conditions are there. Restructuring. So anytime you're doing restructuring, before you make a provision for tax restructuring, make sure that these two conditions are there. Number one, there must be a formal plan. So tell the examiner, formal or plan, official plan. The official plan will be state one. State one. Affected area of operation, area and number of people, redundancy. B, the duration including effective time. Condition number two, the affected persons have been communicated. So communication to the affected persons or people. That's all. So that's all I'm saying, that if I've not done these two, don't worry yourself. Don't make in any provision for redundancy or restructuring. That is all. So here, no provision. So tell the examiner, no provision. Tell the examiner, no provision, because they've not done that. They just announced 10% for what? You inform us the affected area and then the number, the estimate of the number likely people that will be affected. If not, inform us the formal plan. When exactly you're embarking on this? So tell us. And the effective date. Good. So that is it. Okay, so let's look at this particular question. And I like this question too. A couple limited. This is going for 2 marks. Demonstrate how a couple limited should record the cost of site reclamation as of 31st August 2015 in accordance with IAS 37, provision, contingent liability, and contingent what as. Okay, let's start. A couple limited obtained license fee, a license free aside from the government to dig and operate a gold mine. A couple limited spent 6 million digging and preparing the mine for operation and erecting buildings on site. The mine commenced operation on 1st September 2014. The license required that at the end of the mine's useful life, 20 years, the site must be reclaimed. Reclaim means reposition, restore. The site must be restored. Anything, any hole, any pit you dig, make sure that you cover them. Make sure that you restore the land back to its original position. And this is a clear example of what? site restoration cost or dismantle cost. And then there's a full video on this. So a full video on this. And then you are fine. If I've gone through that one, that means you'll be able to probably do this. Let's see. All building equipment must be removed, yes, as usual, and the site landscape and the site landscape. At the first of 2015, I want to say that cost in 19 years' time of the removal and the landscaping will be 5 million, and its present value is what, 3 million. On October 2015, there was a massive earthquake in the area, and the Apple Limited mine shaft was badly damaged. It is estimated that the mine will be closed for at least 6 weeks, for 6 months, and it will cost 1 million to repair. Demonstrate how this be recorded. For 3 solid marks, all the demonstrations are 3 marks. So the commentator has plenty of stuff. Just go straight to the point. Thank God the examiner don't even give us cost of capital to present value. They give us the present value already. So tell the examiner that this 3 million should be treated as a provision. It must be added to the cost of the mine. So the cost of the mine, that is digging the mine, operations, erecting building, everything 6 million. Add the 3 million to it, making what? 9 million to make provision. So this 3 million, according to IAS 37, provision needs to be made for the 3 million. So we should take note of that. We should take note of that. So basically that is it. How do you treat the massive earthquake? The massive earthquake occurred in October 2015. Now, what's the reporting year? The reporting year happened to be 31st August 2015, right? And it occurred 31st October. So it tells that this is a clear example of what event after reporting period. And we've treated this. Yeah, it's clear. Okay, it's even here. Explain how a couple the effect of the earthquake. Okay, so it means that here the IAS 37, the 3 marks is only for the first session. So take note. The 3 marks ends here. That is all. And the 2 marks for here. So it means that the 3 marks, it must be capitalized. It must be added to the cost of the asset, making 9 million. Utilization must follow. So making 3, we need 3 strong points here. Each of them qualify for 1 mark. When you see 3 marks there, make sure that you read more than 3 points for you to be scored full. So first, at that examiner, this 3 million must be capitalized and added to the cost of the assets of what the work is. So solution, that examiner that the 3 million should be capitalized. The 3 million, that is the site restoration cost of solution of 3 million should be capitalized and make provision for. So capitalize and provision, asset and liability, perfect. So therefore the cost of the site mined becomes what? Purchase cost 6 million, and then restoration cost is bracket present value So 3 million. So this and this will give us 9 million, right? Okay, so 9 million, what do you do again? Tell the examiner, depreciation must be based on this 9 million, which will be what? Over 20 years, right? You put the answer down. So are we saying all this will give you 1, all this is also giving you 1. Now tell the examiner that a provision, so this point 1, point 2, tell the examiner provision should be made for the site restoration. Provision need to be made for the site restoration. So tell the examiner that they should make a provision, adequate provision for the site restoration. How do you do that? Let's go to point 2. Point 2 is a provision itself. So point 2, so provision for site restoration of 3 million should be made. Accounting treatment, add this provision to your P&L as what? Expense. Sorry, we are done with the P&L. This is not a main. We've added it already, so add it to your non-current liability. That is all. That is the credit component. Please and please again. The debit, we've already added it to the asset. We have already capitalized it in the point 1 or paragraph 1. So we don't need to do it again. Thank you. So we are done. Again, point number 3. Tell the examiner. Every year, there must be unwinding of what discount, which will be added to finance costs and the liability, the non-current liability. That is all. Okay, so I think we are done answering this question. This part was answered at the event after reporting period section. So if you visit, one of the video contains a solution for this. Just to the examiner that earthquake need not to be, it's not adjusting event at all. Earthquake after the year end does not provide evidence that there's no evidence that earthquake will occur as at the very same low. So therefore it's not adjusting. That is all. Okay, so that is end of this particular question. If I should proceed again, let me see if I can get another one again fast. Okay, so basically that is the end of the game. I'll still look for another terrible one here that you have to look at it for me. Another terrible one here that you have to look at for me. So the way coming, the way coming, the way coming, the way coming. Okay, so now look at this for me before we go. Before we go. Question. So to end the game, let's look at this particular one. It's going for how many marks? It's going for we have 2, 3, making 5. Okay, so we're saying that discuss briefly how each of the above transactions and events should be recorded by Kojak Limited in compliance with the requirement of IAS 7 provision on liabilities and contingent assets. Okay, let's start. D. Total Limited is a manufacturing company which prepares its financial statement in accordance with the IAS. The following transaction took place in March 2017. Total Limited has traditionally repainted its premises every 5 years. The next painting is due in a year's time. The entity proposes to accrue as a provision and an expected cost of repainting. So they just want to make a provision for the next year's painting. So should they record it? That is that before provision needs to be recorded in the books, the following condition needs to be in place. To take note. Number one, there must be a present what obligation. So ask yourself, is there any present obligation either as a result of what legal, contractual, and what constructive? So take note of that. And two, the amount involved can be measured reliably. And then three, it is probable. It is probable that future benefit will flow to that of the entity. That is that. So kindly take note of it. Kindly take note of this. Okay, so basically, that is it. So tell me if the condition has mentioned of them are satisfied. So can you tell me the condition of them are satisfied? Do the second one quickly. Okay. So let's do it quickly to end the game. Let's look at it quickly to end the game. Now, the solution is like this. Tell the examiner, before you can record the accrual or the reaping of the premises, the next year as what? As a provision, tell the examiner, there must be a present obligation. There must be what? A present obligation, be probable, and then the amount involved, or reliable estimate can be made. Now, in fact, here there's no present obligation. There is no present obligation, and hence no provision should be made. That is, no provision. However, however, if commitment have been initiated already with a supplier, have been made with the supplier. Oh, then there's the supplier. Then there's what? Then provision can be made. So as to stand, you cannot make any provision because no commitment has been made. Good. Let's move on to the one. Kodak Limited has guaranteed the debt of its associate company up to a maximum amount of 3 million. The associate is in excellent financial health, and the directors of the opinion that it is unlikely that the guarantee will ever be called, because unlikely. So in short, there's a guarantee, but the guy is in excellent financial health. So that means they are not going to call back this guarantee. So meaning, let's still go by the rule. If I should go by the rule, tell the examiner before they can record this as provision. First, tell the examiner before they can record this or they can recognize this, before this can be recognized as a provision, the following condition must be in place: A, B, C. You know them already, right? Present obligation, probable and a reliable estimate. Code them and come and start again. Even though, so tell the examiner that even though in this question there is a present obligation. Yes, here there's a present obligation. Present what? Obligation. That is examiner. Even though there's present obligation, it is not probable that future economic benefit will flow, and hence no provision should be recognized. How we get it? Here there's present obligation, but it is not probable. The second condition is not there. Why? The company you have secured the debt against is in good shape. So it means that it's likely for you to lose the amount of the security. And the security is what? 3 million. You are not going to lose the 3 million. So hence, it is not probable. Make sure before you record a provision, make sure that you have to pay something that you pay in future. And yet they're not going to pay. They are not going to pay now, because as it stands now, nothing suggests that they will pay, because the guy is in good or excellent financial health. Even though there's a present obligation, yes, they've entered into a contract. As a result, there's a present obligation. But the mere fact that it's a present obligation does not give you the full assurance to record provision. Provision, all the 3 conditions must be there. There must be present obligation. Again, there must be probable. Third one, there must be a reliable estimate. All this must be there before you can record a provision. If any of them is absent, provision is also absent. That's all. Okay, so that is it. Unfortunately for us, this is half part the good Lord brings us with that of the provisions. Now, in regards to the very last one, you can tell the examiner, however, this should be disclosed as what? In the notes. So just disclosed as a contingent liability. It's a contingent liability. Why? Because the settlement of it or the occurrence depends on what? Occurrence or non-occurrence of future events. So therefore, just that we need to disclose it in a book. Basically, that is it. So that note will end here and continue again in our next meeting. Thank you very much for coming. Have a nice day. Kindly subscribe if you have not done that, and share the link to your friends. And you can also join us for question solving. Goodbye, everyone.